Call a spade a spade. BlackRock's a fixed income shop. Of course they're negative. With respect to active management, we've known that active managers have had a hard time performing. They got in this rally very late. They've been underperforming, and the majority of portfolio managers have less than 10 years experience, and they've been more busy the last 5 or 10 years managing redemptions versus managing portfolios, and more succinctly, they're more busy managing their careers. And so lastly, on the Morgan Stanley side, we don't like to comment on other firms' opinions, but let's face it, this is a firm that's been negative for a year. They were right for a quarter, they've been wrong for 9. And so we'd like to think a little bit more fundamental, a little bit longer term. We think it's preposterous that the market thinks we're going to get a 50 basis point cut, that we thought we were going to get a 50 basis point cut. The bond market's clearly in control of what's happening in terms of momentum. People are still negative. They are the most negative I've seen. And I'm not trying to grandstand here. I think investors are more negative now than they were in 2008, 2009. We think this road could be bumpy on a near-term basis, but longer term, we think stocks are higher at year end.
Brent, why don't you take apart what Brian has just laid out there and sort of disarticulating or disassembling those earlier points, and also react to what he just said, which is, if I heard him right, that investors as a group are more negative now than at any time since 2008-9. Really?
Sure. I actually agree with Brian on many points, and I think the first and the third brick of worries are related. I guess, one, if you think there's going to be a recession, to us, the only way that happens is if the Fed tightens too much, because right now it doesn't appear that anything economically, from a fundamental standpoint, is in excess. And the last one is that markets and the economy over longer periods of time, as Brian mentioned, are connected at the hip. And so while Morgan Stanley may get a correction right in the near term, we do think they'll be wrong in the intermediate to longer term, which is towards the end of the year, maybe even into next year. We still think there's a high probability markets move higher. And quite frankly, right now, I do think active managers actually have a chance to provide outperformance just because of the popularity of passive management and the fact that people are buying assets in one fell swoop and doing it in a reactionary manner. I think people who have the ability to look longer term and focus on fundamentals actually have an opportunity to add value in the future, and the weak hands have been forced out.
Brian, point taken regarding Morgan Stanley's track record, but I wanted to delve specifically into a point that Morgan Stanley was making behind its call, and that is that markets are being too sanguine when it comes to what low bond yields indicate around the world. And that's what we're seeing right now. More than 25% of sovereign bonds around the world are negative yielding. Why shouldn't the markets care about that? Are you worried at all that we're facing an inverting yield curve here in the United States and bond yields are terrible around the world?
Well, I would say this. If the Fed cuts, the yield curve is going to steepen. That's number one. Number two, in terms of around the world, we've seen a massive underperformance of other assets around the world relative to the U.S. And for one thing, Europe's the next Japan. We actually have still pretty decent growth here. And one of the things that Mr. Leisman said, I think, is just, again, not correct. We've had the longest recovery post World War II, but it's been the slowest, grindiest, most boring recovery in the history of recoveries. We have yet to get frothy. Typically, recessions happen when we see some sort of frothy growth. We haven't seen that yet. The markets overall remain excessively defensive, and so that's why we think investors in general are going to rotate back to the U.S., quite frankly, because of the stability, especially relative to the rest of the world. Lastly, we have now reared an entire generation of investors that only buy stocks because interest rates go down. That's where Morgan Stanley's right in terms of investors giving the bond market way too much credit. But this notion of only buying stocks because interest rates go down is not fundamental. It's more momentum, and it's really a reflection of what's happened in the last 10 years.